Yo, welcome to I think this is the seventh video for accounting, but it's part 3 of my credit trilogy, so I think that's more important than anything else. So, we're going to be looking at discounts today. So, let's start off with what we've done previously. Firstly, we've looked at accounts receivable, and then we have looked at accounts payable. Cool, so we've done both of those. We know the transactions, we know how it looks, we know what settlement looks like, we know all those little ins and outs. We know how it looks in the balance sheet, we know how it looks in the income statement, we know how it looks in the cash flow statement. We've done all those, they're in the previous videos, so part 1 and 2 of the trilogy. But the next step is discounts. So if we bring up an old transaction, so I'll just bring up one here. I'll bring up the transaction we're using today, and I want you to pay attention to the 5/7 and over 30. That's what forms the basis of our discounts. These are credit terms. So the 5/7 means you get a 5% discount if we pay within 7 days. Otherwise, pay within 30 days, please. And so that's where all our discounts come from. That's how we know how long we've got to pay. That's how long or how much discount we get. But we need to calculate it. So here is the formula. The total discount we receive is discount percentage multiplied by the total amount we need to pay back, or the total amount owing, or the total amount it is reduced. And we'll have an example later on. But first, let's look at essentially what we're doing. So discount revenue is the discounts we earn for paying accounts payable early within that, say, 5/7, that early payment window. And the discount expense is the discounts we give up for accounts receivable paying us early. Now, the reason we want these, why do we want to do this? Essentially, it is to encourage either faster payment in accounts receivable or to earn a revenue in accounts payable. And overall for both, having a better relationship with not only our customers, but also our suppliers. Having good relationships with both means more positive interactions and your business runs better. And there's also actually proof that offering discounts and taking advantage of discounts improves your turnover for both of those. So, shocking. Anyway, let's tick over to our examples. Alright, so our first example, we're going to be doing the discount expenses first. So on the 1st of March, we made a sale of $5,000 plus GST, with the cost of sales being $2,500 on credit terms. Credit terms here, 5/7 and over 30, with customers are us and the invoice 25. Then on the 6th of March, customers are us, settled the account. And we can see right here that between the 1st and the 6th of March, it's 5 days. So they earn their 5% because they paid within 7 days. So let's calculate the discount first. So we plug our numbers in, we go 5% multiplied by 5,500 because that's how much the sale plus GST was. And that gives us $275. That number will be important in a moment. But first, let's do the general journal. So accounts receivable, 5,500, because again, that's the sales and GST. That 5,500 is the debit. GST clearing sales, 500, 5,000 respectively on the credit side. Meanwhile, cost of sales being the expense, 2,500. Inventory, 2,500 because it's going down. And it's an asset, so it's a credit. Everything is as we've done previously. Everything we did in the credit sales video is here again. Now, on the 6th of March is when the account's settled. So how do we do that? Well, let's bring back our math from previously, where we got 275 discount expense. We see that they're settling the account. So accounts receivable needs to be a credit of 5,500. So essentially we've got debit 5,500, credit 5,500. Zero. Cool. But then discount expense 275. Now discount expense is an expense. If an expense goes up, it's a debit 275. And then the remainder needs to be the bank. So if we look at 5,500, we see 275, my mistake, is discount expense. The other 5,225 is the bank. And that's what that 5,500 consists of. Then if we apply that to our general ledgers, we see here that accounts receivable, sales and GST 5,500 on the debit side. Meanwhile, on the credit side, bank and discount expense 5,500. Again, it totals zero because debits and credits are equal, but you can see the discount expense is in there as on the credit side for accounts receivable because it's going down. If we look at the discount expense side, we see the 6th of March, accounts receivable 275 on the credit side. Oh, sorry, on the debit side, because it's an expense, it goes up. Expense going up is a debit. So that's where that is interlinked. Obviously, the bank will also be 5,225 because that's where that would go. Because again, we're receiving money, bank's an asset, bank goes up. So that's how the general ledger looks after that transaction. Now, if we flip around and we do our second transaction for discount revenue this time, we're in April and we purchased inventory on credit from Suppliers R Us and it's valued at $4,000 plus GST with terms of 4/7 and over 30, invoice 52, and right there you can see it's a credit purchase. Meanwhile, on the 5th, they settled the account with Suppliers R Us, check 12, and because they paid within 7 days, they accessed that discount. So this time, 4% multiplied by 4,400 gives us $176. Please remember that 176. It's important. We then look at the general journal and we see everything is as it was before in the credit purchase video. Inventory is 4,000 debit, GST because we paid 400 debit, but accounts payable is a credit 4,400. Everything seems pretty normal, but then on the 5th we settle the account, so obviously accounts payable needs to be 4,400 on the debit side. Discount revenue, going based on our previous maths, is 176, and that is evidenced right now in that, hey look, we calculated this, it's a revenue, it goes up, it's a credit. And then lastly, our bank, $4,224, got stuck on numbers there, is a reduction. Bank being an asset, going down because we paid money, is a credit. And you can see here we have added narrations on all the transactions on the general journal. So they've accessed the discount, and we have a look at the general ledger. We see accounts payable on the credit side is the purchase 4,400, but on the debit side is the settlement, bank, discount expense, total 4,400. And then if we look at discount revenue and bank, we can see the cross references there. Firstly with accounts payable 176, and that's in the discount revenue on the credit side. And likewise bank will be bank 4,224, also a credit. But ultimately we need to look at the report. So let's have a look at the income statement. Now, I know there are some terms there that do look a bit scary, like customs duty, inventory loss, inventory write-down. That is fine. We contact that. We essentially deal with that later. So, but the thing I want to draw your attention to is discount revenue, 1,800 in the other revenue. That's because discount revenue is not our primary business model. It's just something we do to get a bit of extra revenue. Like if I have a term deposit I earn interest on it. That's other revenue. It's not my primary source of income as a business. So that's where discount revenue comes in. Discount expenses is treated like any other expense, so wages, advertising, rent, discount expense, all goes in the less other expenses. So that's where you're going to find those on the income statement. But let's have a look at the accounting equation. Not look at the balance sheet, the accounting equation this time. So if you have a look, we've got A equals L plus OE. And if we have a look at the accounting equation, we'll do the discount expense first. We see that bank goes up 5,225, but accounts receivable goes down 5,500. That's a net decrease in your assets of $275, which is represented in the owner's equity section as an expense. So owner's equity goes down because profit goes down due to the expense. And that's where discount expense comes in. And we can see here both sides, assets and liabilities, owner's equity, both go down by $275. Now, our definition of an expense is that any item that results in the decrease of assets, in this case, the decrease of $275, while also resulting in a decrease in owner's equity, also of the said $275. So that's essentially what we're looking at here for our expense. So that's where that fits in. Likewise, with the discount revenue, you can see a revenue is an increase in assets or a decrease in liabilities that results in the owner's equity, increase in owner's equity, other than capital contributions, but it's not a capital contribution. We know that. So let's put the accounting equation to the test, see if our definition fits. We see here that accounts payable goes down 4,400, so that's a down on the liabilities. Bank 4,224, that's also a down in the bank side, so assets also going down. But the discrepancy of 176 is an increase in owner's equity, because revenue makes profit go up, makes owner's equity go up. So you can see here we're now balanced at both sides being minus 4,224. And then if we look back to our definition on the screen, we see an increase in assets or a decrease in liabilities. So the liabilities have decreased and a net increase in owner's equity, which has also occurred. Ergo, this is a revenue that definition holds up. You love to see it. So that's where that fits in. So the last little bit I want to talk about is accounts payable turnover and accounts receivable turnover, because this ties into the cash cycle. So accounts payable turnover formula is on the screen now. Average accounts payable, start plus end over 2, over net credit purchases plus GST times 365 gives us our answer in days. Net credit purchase is the amount we purchase, less purchase returns. Likewise, for accounts receivable turnover, it will be average accounts receivable, so start plus end over 2, divided by your net credit sales, again, sales minus sales returns on credit, and you include your GST, you add the GST in here, and you times by 365. That gives you your your accounts receivable turnover. Now, but why do we want these numbers? Well, it links to the cash cycle, because the faster we get our money back, the faster we can use it for other items. So by being able to use it for other items, we can use it for anything that ranges from inventory, just using cash, paying back our accounts payable, or short-term other expenses like wages, advertising, rent. We need that money. So the idea of accessing discount expense or using the discount expense is we're encouraging people to pay now, because it's better to have 95% of the money now than potentially never getting any of the money at all. So encouraging that early payment. Likewise, by accessing that revenue, it's better that we pay less now than more later on. Because if we wait, we end up settling the whole account, but if we access some of the discount, then hey, we're paying less, and ultimately that is positive for the business. And that ties into the cash cycle, because it's more money to use elsewhere. And that's generally what holds this all together. More money to use elsewhere. Now, there are some considerations, and I will do a video in depth about all this in terms of how to answer theory, considerations, and the like, because I really just want to be focusing on the practical stuff. So please remember, if it's a discount expense, what I want you to remember is accounts receivable is always linked to discount expense. Meanwhile, accounts payable is always linked to discount revenue. So on that note, I hope to see you next time. Thank you for watching. Like, share, subscribe, and I will again see you in a future video. Peace.